Welcome to the Deep Dive. We've just finished digging through the Q2 fiscal year 2026 earnings report and the call that followed.
Yeah, lots to unpack there.
Definitely. We're here to give you the shortcut to understanding what might be the biggest story moving the market today. We're focusing on this performance. Analysts are saying it's a real turning point for the company.
A much-needed turning point, I'd say. Anyone tracking this knows the market's been, well, pretty skeptical.
Right.
But this pre-market release and call, unlike maybe the last few quarters, it really delivered some palpable positive momentum. It basically reversed that cautious guidance they gave earlier in the year.
So not just numbers, but real execution changing the story.
Exactly. We're looking at execution.
Okay, let's jump right in then. Hit us with those top-line numbers that surprised everyone and set this bullish tone.
Okay, so revenue landed at $129.6 million.
And that beat the street.
Comfortably. Consensus was hovering around, what, $120 to $122 million? So yeah, a solid beat. That's about 3% growth year over year.
Okay, 3% growth. But you said the real story wasn't just revenue.
No, not at all. If you only look at revenue, you miss the pivot. The big news is GAAP net income, $13.3 million.
And why is that the number?
Because it's the second quarter in a row of actual GAAP profitability. Think about it for a company constantly battling that cash burn narrative.
Right. Proving
GAAP profitability back to back. That's the foundation they need for everything else.
And for shareholders, how did that translate?
Non-GAAP EPS came in at $0.04. Again, a clear beat. Estimates were closer to maybe a penny, 0.0001 cents.
So way better than expected. And it wasn't just a sales bump, you're saying. This is about efficiency.
Precisely. That's the core story here. We need to look underneath at the metrics driving that efficiency.
Like what?
Adjusted EBITDA, for instance. It's, a cleaner look at cash operating performance before financing stuff. That number just exploded.
Exploded how?
Up to $25.9 million. That's a massive 72% increase compared to last year.
72%? Wow.
Yeah, and it delivered a 20% margin on that basis.
That's astonishing. Especially when you pair it with the gross margin that expanded too, right?
By 400 basis points year over year. Hit 75%.
Okay, so that's the operating leverage and cost control they've been talking about.
Exactly. Yeah. And management really leaned into it on the call. The CEO made a point of highlighting this second quarter of GAAP profit and specifically called out the QNX division.
What about QNX?
He said QNX achieved a Rule of 40 quarter.
Okay, Rule of 40. That definitely gets my attention. Remind us, that's a key metric for high-growth software, isn't it?
It is. Basically, your revenue growth rate plus your profit margin should add up to 40% or more.
Right. It signals healthy, sustainable growth.
It's the gold standard. So dropping that phrase about QNX, it signals something important. It suggests QNX is maturing into this really efficient, reliable growth engine, a compounder.
Okay, so let's dig into that segment first then. QNX sounds like the linchpin.
It really is. The numbers back it up. QNX revenue grew 15% year over year.
To
$63.1 million. And that was mostly driven by strong royalties kicking in.
Okay, so 15% growth. How do they actually hit that Rule of 40 number then? What was the profit margin?
Well, the segment delivered $20.5 million in adjusted EBITDA for the quarter. Do the math. That's an impressive 32% segment margin.
Okay. So 15% growth plus 32% margin.
Gets you to 47%. So yeah, absolutely validates the claim. And it was the most profitable quarter ever for QNX. Ever. Plus, its segment gross margin is now 83%. As more cars with their software actually hit the road and those royalties flow, that number should just keep getting better.
So the foundation looks really strong. What about future growth? Any big wins locking that in?
Yes, and this is where it gets really interesting. They landed a big one, mid-8 figures, a design win in China.
China for what exactly?
For the ADAS applications, advanced driver assistance systems. It's with a major global tier 1 supplier. Given how fast China's moving on EVs and software in cars, that's huge.
Definitely a key market.
Yeah.
But wasn't there something even more foundational?
You're probably thinking about the silicon partnerships. That's the strategic cornerstone, I think. The big news was QNX OS for Safety 8.
Okay.
It's going to power Nvidia's DRIVE Thor development kit.
Nvidia's Thor, that's their next-gen automotive chip, right?
Exactly. This isn't just another design win. It's like getting baked into the bedrock for the next decade of car tech. This Nvidia platform enables all the next-gen AI stuff, generative AI, and the safety-critical systems for autonomous driving.
So they're basically cementing their spot way down in the tech stack for future vehicles. Very sticky.
Extremely sticky. And they're trying to take that safety expertise beyond cars too, right? Into that general embedded market, or GM.
Yeah, as that call.
Making progress. They mentioned a notable win with a North American camera and vision module supplier.
Okay.
And the application is in automated mobile robots and even humanoid robotics.
Humanoid robotics. Interesting.
Yeah, it shows they're actively looking for these high growth areas where that core QNX strength, safety, reliability is really critical.
Okay, so QNX is clearly firing on all cylinders, the growth engine. But this whole profitability story falls apart if the other side, secure communications, is just bleeding cash, right?
Yeah.
How did they handle that?
Right, good point. Secure communications revenue was $59.9 million. Now, that was down 10% year over year.
Okay, down 10%. That sounds less good.
It does on the surface. Management explained it by pointing to a big device refresh cycle in the prior year, Q2 2025, that kind of inflated those numbers.
Yep.
Sequentially, though, quarter over quarter, the results actually beat their own expectations.
Okay. But still, down 10% year over year. Doesn't that kind of drag down the whole positive story, or are we supposed to just gloss over that?
No, that's a fair question. And it's where you have to look past just the headline revenue number and focus on the recurring revenue metrics.
Okay.
See, if you were bearish on the stock 6 months ago, you were probably betting on massive customer churn in that division.
Thanks, so.
This quarter basically put that worry to bed. ARR, annual recurring revenue, actually grew sequentially. It was up $4 million to $213 million.
Sequentially, okay. And what about keeping the customers they have?
That's DBNRR, dollar-based net retention rate. That improved sequentially, too, up to 93%.
Okay, 93%. So still a slight shrink, but improving. Help us unpack that metric again. What does 93% really mean?
Well, 100% means you're keeping everyone and maybe upselling a bit. 93% means there's still some churn. They're shrinking just a tiny bit overall from existing customers. But the key is the sequential improvement.
All right, the trend.
The trend. It shows the bleeding has slowed dramatically. The business is stabilizing. That churn that plagued them, it's easing off. This division is shifting away from decline towards predictable, sticky revenue.
And they had some wins that reinforced that stickiness, didn't they? Especially in government.
Absolutely. A big one was a 5-year renewal and upsell with the U.S. State Department. That's for their critical events management platform, Ad Hoc. Huge validation for government work.
Okay.
And maybe even more significant for the business model was a major deal with a German government agency. This was for hosted secure voice services.
Why is that so significant?
Because it sets up a new recurring revenue stream for their SysU Smart business. Historically, that relied more on bigger, lumpier, one-off deals. This is steady, predictable income.
And there was a compliance thing, too, something about Germany.
Yes. Huge. Their UEM solution, that's Unified Endpoint Management, became the first mobile device management vendor to get certified by BSI.
BSI.
Germany's Federal Office for Information Security. That certification is gold. It's essential for selling into government and regulated industries, not just in Germany, but across Europe, really globally.
So it basically builds a higher wall around their business in those key markets.
Exactly. Verifies trust, makes it much harder for competitors to push them out.
Okay, let's pivot back to the financials then. The discipline that made the profit possible. They invested more in QNX, right? For GM and the vehicle platform.
Correct. Strategic investments there.
But somehow operating expenses still went down. How'd they manage that?
Adjusted operating expenses actually decreased 5% year over year, down to $74.8 million.
Wow. So spending less overall while investing more strategically.
That level of cost control, combined with the jump in profit we talked about, it allowed for that really critical shift in cash flow. That was kind of the final nail in the coffin for the old bear thesis.
Which was?
They returned to positive operating cash flow. $3.4 million positive.
And that was sooner than expected, wasn't it?
Much sooner. For anyone who's followed this company, hitting positive operating cash flow is just huge. The bear case for so long was just simply the constant cash drain.
Right.
And they hit this positive number even after paying $19 million in taxes from the previous year. So bottom line, they are now officially self-funding.
Okay, self-funding. That changes the game. Now you can think about returning capital to shareholders.
And they did. They put that cash to work immediately, repurchased about $20 million worth of shares.
How many shares was that?
Around 5 million shares at an average price of $3.97.
That definitely sends a message. Management thinks the stock is cheap.
It speaks volumes, shows they believe it's undervalued, and crucially, they have the balance sheet flexibility now to actually act on that belief. And the market noticed.
Yeah, the reaction was strong. Big volume spike. Stock jumped over 8% on the day.
It reflects that this wasn't just meeting expectations. It was a credible reversal. They didn't just meet the bar. They genuinely raised it.
So if the environment outside is getting a bit better and the inside performance is this strong, what does the guidance look like going forward?
They raised guidance across the board, both for Q3, the current quarter, and the full fiscal year 2026.
Okay, give us numbers.
For Q3, they're guiding total revenue between $132 million and $140 million.
And the full year?
Full year total revenue guide is now $519 million to $541 million. That pushes the midpoint up by a solid $7 million from the previous guidance.
And profitability, is that locked in now too?
Seems like it. Full year non-GAAP EPS guidance was raised significantly now, $0.11 to 15 cents. And crucially, that cash flow, they now expect to be cash flow positive for the rest of the year. They raised the full year operating cash flow guide to $35 million to $40 million.
That cash flow number really underpins everything else, doesn't it? The buybacks, the confidence.
It's the bedrock. It supports their whole capital allocation strategy going forward.
What external factors are they banking on to hit these higher numbers? Any tailwinds?
They mentioned a couple of things. Increased stability in the auto market was key. Management actually said, and I quote, "The pause button is being unpressed."
Okay, so auto production may be stabilizing or picking up.
Seems like it. They also cited less impact from global tariff uncertainty, which had been a headwind. And on the cybersecurity side, they're still betting on that macro trend, rising security spending driven by, all the AI-related threats popping up.
Makes sense. Okay, that brings us nicely to our final segment. Time to put on our speculative hats. Encourage some creative, maybe hedge fund style thinking based on all this new info.
All right. This is not financial advice, disclaimer first. But yeah, based on this quarter, there's a pretty clear and now I think credible sum of the parts trade emerging here.
Okay, walk us through it.
Look, the company still has a strong cash position, right? $363.5 million. And crucially, they've now shown that the corporate overhead and the secure comms division are no longer this guaranteed persistent cash drain.
They're self-sustaining or close to it.
Exactly. Which means you can finally legitimately start valuing the QNX division separately using actual software multiples.
Because it's behaving like a high-quality software business.
Precisely. The trade thesis is simple. The market has always undervalued QNX because it was stuck inside this larger entity that looked, frankly, distressed at times.
Right.
But now, QNX is consistently executing, hitting that Rule of 40 profile. Remember, 15% growth, 32% margin. It deserves a premium high-growth multiple separate from the rest.
So the trade is betting on the market finally recognizing that value. How do you play it?
Well, you could structure a synthetic long position targeting that multiple expansion, focus just on the QNX value. And here's the catalyst. Given the cash hoard, and that raised positive cash flow guidance for the whole year.
You expect more buyback.
You have to anticipate an accelerated share buyback program, more than the $20 million they just did. The core strategy is basically using that balance sheet flexibility and this new floor of profitability they've established to force the market towards a sum of the parts valuation, maybe somewhere closer to, say, $8 to $10 per share.
And the support for that is QNX's consistency and management's willingness now to return capital.
That's the argument. The QNX performance provides the value, the cash flow, and buybacks provide the mechanism to unlock it.
Okay, so wrapping it up, the key takeaway here feels like this quarter marked a real pivot. Not just stabilizing, but actual selective high-margin growth. QNX leading the charge, but with disciplined execution everywhere else.
Yeah, they grew the top line year over year, expanded gross margins, and cut operating expenses all at the same time. That's solid execution.
Which leaves us with a final thought for you, the listener, to chew on.
Right. Given that huge win with Nvidia's DRIVE Thor platform, which is all about generative AI in cars and these interesting new wins in robotics, both mobile and humanoid, you really have to ask yourself, how quickly can that other part of QNX, the embedded business outside of automotive, how quickly can that grow into a second major growth engine, maybe starting in fiscal 2027?
That's where the next leg of growth might come from.
That could be where the next big value unlock originates. Something to definitely keep an eye on.